joining us on today's session. I'm Ashley Bloom, Marketing Manager at Raffingers, and this is Barry, Partner at Raffingers, who is our accountant we are going to be asking questions to today. So before we begin, just please make sure you comment with any of the questions that you've got. Remember, it's not often that accountants give away their advice for free. So use this session to your advantage.
I was going to say, firstly, we never do that. Secondly, I don't like this new app because I've aged dramatically since this morning, according to that. And I mean, it's probably the thought of giving away my advice for free has put years on me by the looks of things.
So to begin, we've had some questions sent through. So I'm going to whiz through those while your questions come through. We've got some really strong property-based questions. So if you're in the property industry, make sure you stay tuned because there's some questions and really strong advice that Barry will provide all around kind of that for the property sector and how to set up a new property development company and that kind of stuff. We've also got some questions to do with people that have taken out B-bills loans and things like that and what to do in various different scenarios. So I am going to kick off with the first question, which is, somebody has a successful trading business, but wants to use the excess profits to invest in a property. What's the best way to do this? Is it via an existing limited company or a new limited company or personally?
Okay. Well, first things first, we need to get better at you giving me the questions in advance because I can be better prepared. But you know, I can rock up and do this no problem. Okay, so we've got a guy who's made some money, wants to invest in property, has the money in a company. There's quite a few competing and complex issues around here, so we'll kind of run through them as quickly as we can without boring everyone. So the first issue is it's tempting to say, well, we would invest via the existing company because it means we don't have to extract the cash and there's no tax. There's no tax loss on extracting the cash to do it with. The danger of that, and this is more a commercial rather than a tax reason, is putting properties in. Actually, there's tax and commercial reasons why you wouldn't normally do that. From a commercial perspective, you wouldn't normally put properties in the same company as a trade because you're putting the asset at risk. Mainly around, you know, trades are notoriously volatile. You know, you can suddenly take a downturn or maybe you get sued by a customer or a supplier, and the asset that you have is at risk if it's in the same company. So for commercial reasons, you wouldn't normally do it. There's also good tax reasons why you wouldn't do it. The main one of those is well, there's two really. One is inheritance tax. If you've got a trading business, God forbid something happens to you and you die, the value of your trading business normally, with some various exceptions, but normally will be excluded from your estate from inheritance tax, which means it doesn't get included. If you have a property, an investment property in a trading company, you could risk that exemption. So it won't just be that the value of the property drops into your estate, the whole value of the business too could drop in your estate if it's significant enough in relation to the value of the business as a whole. So for those reasons, you wouldn't normally put it in the same company, which means putting it in a new company. The question then is, how do you get the money from the existing company to the new company? And because if you just extract it and then reinvest it, you're going to lose some of it in tax. And it's not a simple answer to that. There are some difficult questions and difficult issues. You can certainly in the short term loan the money across to a new company, although that does also potentially create the same issue, the tax issue that I gave before, and the same commercial issue actually in some ways. But those can be addressed. So that would be the norm. You'd have a separate company. You almost certainly wouldn't put it in the same company.
Perfect. And just to carry on kind of the property development path, because we have had various different questions on that topic. So what is the best method for setting up a property investment company? Is it limited company, sole trader? And this is setting up one from scratch. And if the answer is kind of, it depends, can you just give some examples of what is best and why for different reasons?
Yeah, sure. The answer is it does depend. We're talking about property investments now, not developments. I know you had some questions on developments. Not that you fed them to me first, but I kind of know. So we'll stick to investment. Yeah, it does depend, and it depends on a number of different factors. Firstly, what other income you might have. So if you're in full-time employment as well and earning a reasonable salary, you almost certainly would use a company in those circumstances. Another factor would be how much extra debt you'd be taking on. So would there be mortgages, or are you investing for cash? Because there's interest relief restrictions for individuals that don't apply to companies. The availability of mortgages, they're often harder and more expensive to get in companies. That's a factor too. So there's a whole range of competing factors, and everyone's circumstances are different. But generally speaking, if you're in employment and you have other income and you're taking on mortgages, which is the most common scenario, you would use a company. The problem with using a company is, again, this is another factor, is there's higher costs. So if it's just going to be one property, then the tax savings that you might make from having in a company might be offset by the higher costs of. So if it's going to be a development, if it's going to be you're building a portfolio over time, then you're in those circumstances, you'd probably have a company. If it's a one-off, again, you'd have to consider how much you're saving compared to the extra costs. So the answer is it does depend, and it depends on lots of different factors and individual circumstances. But what I will say is this, that it's increasingly common to use companies rather than invest individually for the sorts of reasons I've alluded to. But again, as I say, it's not 100% certain that will be the answer for everyone.
Okay, cool. And we've had a question from somebody thinking about going into property development. Is there anything specific you would advise for somebody making initial considerations?
Yeah, so we're talking about developments now, not investments.
Developments now.
Right, so if you were looking to do a property development for the first time, and it's a pretty specialist area, so it's one of these things that everyone thinks is really easy to make money on, and anyone who's done it will tell you it isn't. It's incredibly tough and things can go wrong very quickly. But putting that to one side, just from a tax perspective, yeah, I mean, there's some obvious things. You would almost certainly use a company for it. Property development's notoriously risky. You wouldn't want to, for commercial reasons, wouldn't want to put it in your own name. It's also tax reasons. Broadly speaking, you'd expect to pay a much lower tax rate on development, because development, the profits you make on developments are income, they're not capital. So you tend to find that companies will pay lower tax rates on profits. There's also there's quite a few VAT issues around property development that would almost certainly need some advice for most people. Sometimes that would be, someone's calling me, just get rid of that. So it proves we're live. Yeah, so there's all sorts of tax issues, VAT issues around the developments, to, you know, how much VAT you're going to incur, how much of it you can recover, what's the VAT position when you sell stuff. And you get very different answers depending on the type of property being developed, what you're going to do with it, if you're going to keep it, sell it on. There's also structuring issues. You would, you know, very often if it's going to be a series of developments, you'd probably create a group for that for all sorts of tax and commercial reasons and financial reasons. I mean, I could go on all night about this, but everyone, the truth is everyone's circumstances will often give you a different answer. But those are the main issues you talk about with anyone looking to do a development. And
regarding mortgage payments and interest, how are these deducted from rental income when calculating tax payable?
Again, it will depend on on whether you've done it in a company or not. Broadly speaking, companies get, again, we're going to get into a very difficult area, but companies get deductions for interest almost in full. I say almost in full because there is, for the last few years, we've been living with the thing called the corporate interest relief restrictions. And those are amongst them, probably not even amongst, probably the most complicated piece of tax legislation that's ever been passed. The good news is for most small investors, it doesn't apply. In order for the CIR, which is what we refer to apply, you've got to have annual interest of more than £2 million. So for most people, it's not an issue. You're talking about the people who have those issues are the big corporate investors. But even for them, for property, there's usually a way around that. But again, we're into a highly complex area, so I won't go into that in depth. But broadly speaking, companies can deduct interest. Individuals can, but it's much more complex. So they can. The legislation is geared towards them only getting basic rate tax relief on interest. The way it calculates it is much more profound than that, and has a much more profound impact than just. So often you can find it can have quite damaging impact on people who have other income, which is one of the reasons why people with other income tend to invest via companies, because the interest relief restriction rules hurt them quite badly.
Okay, and just for us idiots out there, CIR stands for
corporate interest relief. Is it corporate interest relief or corporate interest restrictions? I can't remember, but it's about debt interest for companies. I mean, that's
fine. Okay, cool. And what are the new rules coming in for non-resident landlords from April 21?
Okay, so non-resident landlords from April 20. I mean, I'm not sure exactly what they refer to because there's so many changes in law for non-resident landlords. So for the last few years, we've had lots of changes. We've had for non-resident landlord companies since 2020. I think there's so many changes. I forget the dates. I think it's 2020. They are now within if they own UK property, they're now within the scope of UK corporation tax. Since 2015 and 2019, staged for different types of property, residential and commercial. We've had capital gains tax introduced. As of this year, April 21, we've now got a different stamp duty rate for non-resident landlords compared to UK residents. Oh God, I'm thinking on my feet here. There's so many different things. I think they're the main ones. But yeah, there's lots of changes for non-resident landlords over the last couple of years.
Cool. I do think some of these questions are quite tricky. So if you need to take 2 seconds to
they're not tricky to answer. They're just what I'm trying to find. To give actual detailed answers, you'd need a really specific set of circumstances. I can give generic answers, but but they're not. The detail is all the devil's always in the detail with this stuff. So
So if you do have any questions like this and you want specific answers based on your situation, without a doubt, get in touch with us directly. So Barry, following the recent budget, can somebody get a super deduction tax allowance for purchases made for rental properties, both in a limited company and in my personal name?
So residential, the short answer is no. The slightly longer answer is maybe if you have a residential property that has things like common parts. So if you have a block of apartment block, that has lifts and sort of areas that are covered by service charge, then maybe, but probably not. Commercial, slightly more complicated. Again, it's a maybe. Depends on the individual circumstances, but it's possible. Yeah.
Okay, cool. And this question is slightly off of the property topic, which obviously has been what people are keen to pick your brains on because you do specialize in the property sector, amongst many other sectors that you've got specialisms in. But on a side note, what do people do if they can't pay back their bounce back loans, which are now due after the long holiday payment terms and all of that? They're now starting to be due in now, right? What's the
they are. I mean, what should they do if they can't pay them back? I mean, let's start by talking about the general. They're quite generous, the terms for paying them back. You can have up to 10 years. And given that the maximum loan is 50,000 for a bounce back loan, you're talking about, in theory, the interest rate's incredibly low, so we'll ignore the interest. You're talking about annual capital payments of broadly 5,000 a year. I'd like to think most businesses that borrowed 50,000 would be in a position to make capital payments of 5,000 a year. But let's assume, but there will be some that can't. So, ultimately, if you can't, then you're insolvent, and probably you have to. The treatment of bounce backs is not that the government will write it off; it's that the government will step in the event of an insolvency. So the only way out of them is insolvency and ceasing to trade. You can't carry on trading and expect the government to come in under its guarantee and pay off your loan. That's not going to happen.
Right, and we have got an article with a bit more information on that over on the website, so definitely check that out if you want to get a little bit more information. And somebody's looking to acquire a new business, but they don't know if they're being offered the best deal. What can they do?
Get some decent advice. When you say the best deal, I mean, again, the problem with valuations on businesses is it's an art, not a science. I always, when I describe it like this. Okay, if I said to you, you want to buy my accountancy practice, right? And if anyone does, I'm always open to offers. But if you want to buy, it's worth a lot more to somebody who knows accountancy and who's running an existing practice than it is someone in off the street. So the first thing is that's two different values. When I always say when you're valuing a business or to buy it, I always ask there's two factors to consider. One, what is it worth to you? You know, having it, what does it bring to you? You know, can you do something with it that the existing owners are? Are there savings to be made by you merging your business with theirs, or is there some customer you'd like to access that they have access to, or some product line that they have that you don't have that you'd like access to? So what's the commercial justification for it? And then having established what the commercial justification is, it's then establishing what it's worth to you. And the way you establish what it's worth to you is, well, what's it going to cost me, and how much is it going to generate for me? How much do I anticipate it bringing in? How much is it going to cost me to fund that? And from there, it's a simple equation. Is that funding equation worth what it brings to you? And if it isn't, don't touch it. And if it is, do. But I mean, there's no straightforward answer to that. You know, what is it worth to you in terms of what does it bring you in terms of profits and income? Extra, and what's the funding equation? How much is it going to cost you to fund it? You know, because most businesses, you know, if you need to go and buy a business, then you don't necessarily need to have that cash available today. You can, if you have, great, but you can borrow. Certainly, most people in that situation would be borrowing some of it.
And speaking of borrowing, if there are businesses at the very, very early seed stage that are literally just starting out, how can they decide whether it's better or whether they're better to get a loan to get their kind of initial stages of funding, or to try and get investment? How do you make that decision?
So, I mean, it's quite an easy decision. Normally, you try and borrow. There's several reasons why you would always, first of all, borrow rather than get investment. Firstly, it's a lot easier, so it's quicker. Secondly, it's a lot less risky, despite the fact. It's a lot cheaper, despite the fact that, you know, it's tempting to think an investor is cheap because you don't have to make regular repayments and fund interest. In the long term, if you're successful, you're going to be paying away quite a sizable chunk of your profits, and you're going to be, you know, ultimately, if there was ever you were lucky enough to sell the business, you're going to be paying away a big chunk of that. Those people are not going to be in it for any other thing other than their profits. So it's going to take longer and it's going to be more expensive. The only reason you would get investment is either A, because you can't raise debt finance for whatever reason. You haven't got security, you haven't got, you know, you've got no profits to support it, you're at early stage. Or the investor offers something that you don't have. You know, very often you partner with somebody who has access to a particular market or something like that. So there are reasons why you would go for investment, but in 90% of circumstances you wouldn't. You would be looking to borrow because it's cheaper and quicker. And
if you are looking to borrow your first or borrow funds from the bank, what are the sort of things that you need to put forward? Is it business plan, and what kind of things do you need to be showing them to get them to buy into you and give you funding?
So most banks will expect, if not a business plan, certainly some outline of the future. And that, you know, when I say a business plan, I'm talking about full narrative and lots. They're certainly going to want to understand the reasoning, why you want and why you need the money. You know, they're not in it just to prop you up. They're in it to see, you know, does this money that they're giving you enable you to grow the business and do something you wouldn't otherwise be able to do? You know, so they'll want to understand the rationale behind the borrowing. They'll want to understand the difference the borrowing will make to the business, why you need it. They want to understand how you plan to pay them back. Traditionally, they'd want to know what security you can offer for it. In these days of bounce back loans, well, we're not in that anymore, but whatever they call the new, I can't remember what they call the new one. You probably know
recovery loans.
Yeah, that one. In these days, the security issue is perhaps less stringent than traditionally it is. But yeah, we won't be long before we'll be back in the situation where banks are looking at what security you've got. So I suppose that's a factor too. Those are the main ones, I guess.
And Adam recently wrote an article that was his opinion, and just for those listening, Adam's one of the partners here at Raffingers, that was his opinion on what was more important for a business, profit or cash flow. Before I tell you what his kind of outcome from that article was, can I get your opinion on what is important for a business, profit or cash flow?
You're trying to catch me out today, aren't you? That's just mean. I mean, this is just opinion. It depends. I mean, for most businesses, cash is always king, because, you know, it's not very well having lots of profit if you run out of cash. And it's not an uncommon story that businesses, particularly ones that grow too quickly, they generate lots of profit, but they run out of cash. Yeah. I mean, they're both important is the short answer. You wouldn't have a business, you wouldn't want a business that wasn't making profit in the same way you wouldn't want one that was running out of cash. I mean, are they equally important? I guess it depends on the individual circumstances. But I wouldn't imagine those are, look, I wouldn't want to prioritize one over the other, is the truth. You've got to manage your cash very carefully, and you've got to make profits. I mean, if you're not doing both of those things, well, then you're probably not running a business.
Well, that was the general sentiment of Adam's article. So,
oh, look at that. And I haven't even read the article. I'm that good.
And that is how aligned our team are, people. So that was just a question I just threw out there for absolutely no reason. Nobody wanted to.
Because you're trying to catch me out and you enjoy watching me squirm.
But somebody has messaged in and said they want to scale up, but they're finding scaling up harder than they expected. In their minds, and I've spoken to this person, it was just a matter of, you know, double our profits. But there was a lot more to it that they realized in terms of like scaling from that initial startup phase to that real phase of growth. Is there any tips on just what they can do to help them scale that are maybe at foundation level? So is it about getting the right team in? Is it about what can they do?
So, I mean, obviously, I don't know who you're talking about or the circumstances. It's really difficult to advise. But scaling up is, I mean, it's quite an... I think I might have told you this before, but I'll tell the world now, such as anyone's listening. I don't know if anyone is, but let's assume there's lots of people listening. You know what word I literally hate? I literally hate the word strategy. It's a horrible word. Mainly because it's quite, I mean, it makes me cringe saying it even, because it means so many different things, so many different people. You can sound really intelligent by talking about strategy and say absolutely nothing, because you can talk at very high level without ever saying anything in detail. And lots of people do that, particularly consultants, I find.
And marketeers. And
marketeers. So strategy is a word I hate, but that said, I'm going to use the word strategy for no other reason. I can't think of a better one right now.
Yeah.
I said strategy for me means is a three-stage process. There's the two easy bits, which we're all really good at, and then there's the tricky bit, which your friend or whoever messaged in is finding. The two easy bits are what I call the inventory stage. Often, again, another phrase I hate. You heard the word SWOT: strengths, weaknesses, opportunities, threats. It's a SWOT analysis. Yeah. It's basically an inventory of where you are today. What are you good at, what you're not so good at, and what opportunities and threats are out there for you. It's like kind of an analysis of your current position. Where are we today? In what state? And we're all pretty good at that, and it's a pretty interesting exercise to do for most businesses. And then we're also good at the second stage, which is kind of putting the vision in place for where we want to be. So we start by saying we're here. It's difficult when you do it on screen. We're here and we want to get to here. Yeah. Right? And we're pretty good at mapping out that, at sort of getting a picture of that and mapping out that. The bit that's really important, and the bit that we're all terrible at typically, is drawing the line from there to there, because it doesn't tend to go like that. It tends to go.
Yeah, sure.
But because what we're trying to do is understand what are the obstacles. Because it's very easy to say, well, we want to go from there to there. But of course, the reason we're not there already is there's a whole series of obstacles in the way that stop us getting there. And the key to any good strategy is firstly understanding those obstacles, what they are, and actually, you know, and that's an evolving task, because, you know, no good plan survives first contact with the enemy. So it's kind of understanding what are those obstacles, and then from there having a plan for dealing with each of those. So if, you know, one of the things you might need is more finance, another thing you might need is a bigger team, another thing you might need is more customers, another thing you might need is a different product line, another thing you might need, we could go on all night, the sorts of things that might get you from there to there, right? But you've got to have a plan for what those things are so that you can get around the various obstacles. And then it's also got to be flexible enough that you know that you're going to get it wrong along the way, and you can keep your that's what it's about. It's about doing that third stage of any strategy planning. And most of us don't do that. Most of us are really good at stage one, where we are, stage three, where we want to be, but we're not very good at the bit in the middle. And I suspect your friend's struggling with the bit in the middle. She's mapping out where or is it, I'm assuming it's a she, it might be, you said she, I think. Is it a he? Yeah, I think you said she. So she's probably given a lot of thought to where she is today. So she's got a realistic kind of view of where she could get. She's probably given a lot of thought to where she wants to be. It sounds like she has. Probably the bit that's undercooked is the bit in the middle. Yeah. Where she needs some help, I suspect.
Oh, okay. And I've gone through most of the questions that have come through. So I'm just going to wait and see if anyone posts any questions on the comments. But I will just throw out a curveball question to you, which is there anything right now in the world of business, finance, accountancy that people need to know and should be thinking about, whether that's new legislation or like a big new update that affects a sector, or any changes, you know, like when II-35 changes first came around or whatever? Is there anything right now that our listeners should be aware of that is happening?
Well, first thing they should be aware of is that you didn't tell me you were going to ask me that question, and then you really put me on the spot, which you so enjoy doing, I've noticed. Oh, God, that's a really unfair question, that is. Can you tell me the answer to life, the universe, and everything is what you
I can if you want.
do you know what the answer to that is, by the way? Do you know what the answer? I'm buying time here. Do you know what the answer to life, the universe, and everything is?
No.
You need to read Hitchhiker's Guide to the Galaxy. It will tell you the answer is 42, I think.
Right.
So what is the answer to life, the universe, and everything? I haven't got a clue. I don't know. Oh, God, you just asked me. Speak.
Well, we have had a question in, so if you want, I can ask the question that's come in from Ollie.
I was about to give you a really good school time anecdote, but I suspect the question from Ollie is more useful. My English teacher used to suddenly turn up in lessons and say, right, today I want you to give me 20 minutes on the hole in the polo mint, or something equivalent like that. That's what you just did. Give me 20 minutes on the whole of the polo mint.
I'm going to give you a bit longer for the other question, but if I change the planning use of my part retail and residential property to a full residential use and then sell it, would I pay capital gains on the profit made?
Yes. That's a short answer. The longer answer, which I suspect is what Ollie's really looking for. So I'm assuming from the tone of what he said is that the residential part is currently being used to live in rather than rented. Because if it's rented, then absolutely there'll be capital gains tax on the full part. The impression I get, the reason he's asking is that he's got maybe a flat above a shop that he lives in. He owns the shop and the flat, or maybe some equivalent like that. And he's thinking of turning the whole thing into residential, living in it, and then selling it for capital gains, and wondering if he pays capital gains tax. Mm-hmm. The reason he's asking that, and for anyone who doesn't know, is that most people think, to an extent correctly, that we don't pay capital gains tax when we sell our main residence. And that is because it's not a straightforward exemption. It's because of a thing called private residence relief. Which occurs when we sell, we don't have to claim. It's automatic when we sell our residence. Mm-hmm. And in most cases, when we buy a house, we live in it and we sell it, it's a straightforward exemption. We just get a full exemption on any gain that we make. In situations where we maybe rent part of the property for a period of time, or maybe we've used part of it for commercial purposes in our businesses or something else, then the residence relief is partial. There are ways it's calculated there's a method of calculating how much of the gain is taxable. Just by changing the property, which has previously been retail and rented or used in a business that he owns, into a full residence, won't exempt the whole gain. There will be a time apportionment, and there'll be a way of apportioning the gain. The longer he lives in it subsequently, then the less of that gain that will get taxed, is the board position. Okay. But yeah, the answer is yes, he will pay capital gains tax if he makes a profit. Okay,
Ollie, I hope that's answered your question. If you can pop any other questions that you've got in the comments, that'd be great. But I'll just circle back slightly.
Oh, you're vicious.
To just what should people know?
The list of things that people should know is endless, but putting me on the spot. Okay, I'm going to pick something. What can I talk about? Okay, I've got something. Let's go with IR35. It's really topical at the moment. Mm-hmm. So I never, you know what? There was a period where we used to get asked a lot about IR35. Then it went really quiet.
Yeah.
And now it's back in the headlines again for all sorts of reasons. Now,
is it because it got delayed? It got pushed.
It's because the rules have changed. Suddenly everybody's talking about it again. Mm-hmm. The rules have changed for good reason. The previous rules, which we've had for broadly 20 odd years, 23, 24 years, have been completely ineffective. Generally, most people have ignored them in the main. I am actually currently involved personally in a very high profile IR35 case that's going through the courts. So I've had to have some bitter experience of it in recent years.
Yeah.
What should they know? I mean, the main changes, one of the things I get asked a lot by people who are affected by the changes, is to explain the new rules. And the new rules are interesting because they haven't actually changed the underlying position. Whether somebody is caught by IR35 or not hasn't changed. The rules are absolutely identical. What's changed is the implications for that. So if previously you had been caught by IR35, then if you were the employer, in inverted commas, it wouldn't be your problem. It would have been the problem of your contractor and his company. Yeah. What's changed is that they've moved the responsibility, broadly speaking, to employers other than small employers. And that has moved the goalpost quite dramatically, because people who previously were operating under, in their own companies and billing and claiming not to be within IR35, often with very good reason, their employers are now faced with having to assess their status. And if they reach a different conclusion that actually they are caught, then the implications are quite profound in terms of tax for the individual. So it's become a kind of topical area, both from the point of view of people who previously were happily trading as a limited company, now finding they're going to have to pay a lot more tax because their employers assess them differently, through to companies who are having to carry out these assessments, on a huge scale. And yeah, so that's kind of, we're getting, honestly, I probably get asked every week at least once about IR35.
Really?
Yeah.
And just broadly speaking, what are the main sectors that IR35 is going to be affecting in terms of like the employers and various
the places it's had a really profound impact are temporary recruitment sectors and the entertainment industry, where a lot of people operate through companies, presenters of radio, TV, that type of thing. That's been hugely profound. I can see we've got a question from Ozzy Chung. Blimey, Ozzy, I haven't seen you in years. How the hell are you? He makes the best tea, can I just say? Ozzy, Ozzy was my senior. I worked on, he was like kind of not quite my boss, but I certainly worked in the same office, and he was more senior. He made the best tea of anyone.
Well, Ozzy wants to know, do I have to pay income tax for my pension payment?
God, Ozzy, are you that old that you're getting pension? Oh, crumbs. He must be, actually. Yeah, broadly speaking, yes. Pension receipts are taxable. Yes. It's taxable, and your pension company will normally deal with it under PAYE.
Ozzy, it sounds like Barry could do with one of your cups of tea. So I'm sure.
Oh, so good, Ozzy. If you're in the area, drop me in a cup of tea, definitely.
And just to let you know, Ollie said that the flat was above the shop, not a separate, and is not rented out. So thank you. You answered his question. That is all of the questions we've had in. I think I'm going to wrap up now because we're not getting any more questions in at the moment. If anyone does have any questions, in the comments on both YouTube and Facebook, wherever you're listening, we've posted our email address, our contact form to the website. Make sure you check out the blog. There's loads and loads of good resources on all of the topics that Barry covered. And yeah, thank you for listening. Thanks, Barry.
Cheers. Thanks, everyone.
Bye, guys.